Welcome to the Lend Academy podcast, episode number 178. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It Fintech. Today's show is sponsored by Lend It Fintech USA 2019, the world's leading event in financial services innovation. It's coming up on April 8th and 9th, 2019 at Moscone West in San Francisco. We've recently opened registration as well as speaker applications. You can find out more by going to lendit.com/USA. Today on the show, I'm delighted to welcome Charlie Moore. He is the CEO and president of Global Debt Registry. Now, GDR have been around for a while, particularly in the marketplace lending space, but their goals are much bigger than just this space. They really are looking to transform the structured credit markets and bringing more efficiency and transparency to these markets. So we go into that in some depth. We talk about what their technology is, how it is actually going to change the securitization markets. We talk about what they were doing before they incorporated blockchain, and what was the aha moment for Charlie in really shifting the direction of his company. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Charlie.
Thanks for having me, Peter.
Okay, so I'd like to get these things started by giving listeners a little bit of background about yourself. Maybe you can just tell us what you've done in your career, before you got to Global Debt Registry.
Sure. So I've been involved in emerging technology and financial services for the last 25 years, running innovation and new ventures type groups at Thomson Reuters here in New York, and previously Barclays and Lloyd's in the UK. Really been involved in this space ever since the first dot-com boom in the mid-late 90s, where I got caught up in the potential opportunities and did my own startup, and have been doing sort of new ventures, be it startup standalone or within large corporations, financial institutions ever since.
Mm-hmm. So your accent then, you're from London originally, are you, or where are you from?
Originally from London, yeah. I've been here 12 or so years. Came over with Reuters, but also married to an American.
Right. As am I. Yes, I understand. Okay. So then, you joined Global Debt Registry a few years ago, and actually, maybe we get started. Why don't you tell us? Because Global Debt Registry has been around, quite some time. I wasn't aware of it myself till I started doing some research prior to this interview. How long it had been around. So maybe you can tell us a little bit about the history and how you got involved.
Sure. So Global Debt Registry, or GDR, has been around eight or 9 years. And it started life in the non-performing accounts world, so the charged-off receivables, and really focused on helping prove chain of title and asset integrity in that market, which if you're familiar with the charged off world, it's very, very messy in terms of keeping track of these charged off accounts, and the record keeping isn't as robust as it probably needs to be. So I got involved about 3 or 4 years ago, coming out of a large company at the time, really because I was seeing a lot more innovation in terms of financial technologies occurring in the small startup world, as opposed to the large corporate world, and that generally continues to be the case.
Okay, so then you got involved. You started off as like the chief commercial officer. It seems like. Right. So I went back and I actually watched your Finovate demo from 2014. So, you've been there a while, but so what did you see specifically about the opportunity at GDR?
So a very large, inefficient market, which with lacking any infrastructure or standards or ways of actually keeping track of transactions, which, having come from capital markets world, focused a lot on the real-time trading activity and sort of research, distribution, and so on, where everything is extremely well tracked and a lot of regulatory controls as well. I was surprised that there was this very large charged-off world lacking infrastructure. But over time, it sort of was clear to us that really to address the asset integrity issues with performing accounts or non-performing accounts, really you needed to start with performing accounts and start further up the chain, and that a lot of the underlying issues and challenges and inefficiencies, they weren't unique to sort of the debt sales market. It really was throughout the sort of the account life cycle. So we started looking at the performing accounts world and working with the investors and the senior lenders supporting particularly digital lending, and we can talk about that asset class in a bit more detail. But we started working with the participants in that ecosystem to generally improve the efficiency and the integrity of the underlying assets a few years back.
Okay. So then, it strikes me as you're talking then that this is really the financial crisis was caused by part of what you were talking about there, sort of the lack of integrity in the underlying loans. I mean, there are people that we know today, that might be tens of thousands of people whose loan documents just didn't seem to exist anymore. And so certainly there was a problem with integrity of data back then. Is this the problem that is that sort of the idea that kind of germinated this whole problem?
I mean, it's clearly something in the back of everybody's mind. I think any technology is only as good as how it's implemented by people. And so, whilst, we can talk about the sort of the power and value that blockchain generally brings to this party, it's only as good as how an industry organizes itself and people choose to adopt and apply that technology. So could blockchain technology improve the sort of immutability of record keeping and ensure that loan information wasn't misrepresented or lost, and that the underlying loan documents and records of ownership and economic interests and so on are much more robust? Absolutely, but only if applied appropriately, only if the right parties sort of agree as to how it should be done. So, clearly there have been some improvements post 2008 in terms of improved investor transparency with Reg AB, but we're still lacking a lot of sort of the infrastructure really required to move the industry on, which blockchain we believe provides a lot of that potential.
Right. So that you already mentioned blockchain a lot, and I'll get into that in a bit. But I'm curious, because when I watched your Finovate demo, obviously you didn't mention the word blockchain was not mentioned back then. So when was it that you sort of changed your premise or how you were going to kind of solve the problem?
Sure. So the business as a whole has been focused on what I would broadly call asset integrity, and there's a number of elements to that in terms of different loan characteristics. I think my aha moment, and everybody has an aha moment, I was exposed to cryptocurrencies fairly early on, and I didn't really get it, and I was somewhat cynical sort of back in 2012-13. It wasn't until probably 2015, maybe early 2016, when I was actually watching a presentation from Leanne Kemp at Everledger, who founded the Diamond Registry on the blockchain. It was talking about the provenance of stones, of diamonds, and talking about keeping better quality records of the quality of the stones, the cut and the color, et cetera, as well as the ownership and chain of ownership, and ensuring that they weren't blood diamonds and so on, and reducing some of the repetitive costs around verifying those diamonds multiple times. And I'm sitting there listening to Leanne, and I think, hang on a minute, these are all the same underlying challenges that we have in the credit ecosystem in terms of keeping track of loans. So that, I think, was around 2015 or 16, which also coincided at the end of 2016. The SFIG Trade Association put out a white paper with Deloitte that aligned very much to our business plan and the business case that we're put forward. So that was good validation. And I think over the last couple of years, the evolution in terms of understanding of the opportunity and the application of blockchain technology has evolved from beyond just the sort of immutable, better quality record keeping through the shared system of record and a vehicle to ensure that everybody across the credit ecosystem is looking at the same loan data simultaneously, and that the current email Excel type model hasn't got out of sync across services, backup services, loan data agents, rating agencies, investors, or senior lenders, etc. And then most recently, obviously, the power and the opportunity of having everything on the blockchain is that the actual asset, it becomes a digital asset, a truly digital loan, where it is native to the blockchain and only represented on the blockchain and can be very easily transacted with minimal additional friction and cost and time delays. So that's been a journey. I think we're all on something of a journey here, and we're still all at relatively early stages of it. But our understanding in terms of what's required for that and what we need to be building to support the industry on that journey has evolved quite rapidly over the last couple of years along those lines.
So your solution today is a blockchain based solution. Is that the only?
Right.
Is that the? Well, why don't you tell us a little bit about the solution itself and whether it's 100% blockchain based or what?
Sure. So what we've been building is what we would describe as decentralized market infrastructure, really the protocols for how loan characteristics should be recorded on the blockchain. So it is a complex market, and there are multiple characteristics that really make up a loan. The asset isn't just the original authoritative loan documents. That's obviously critical in terms of ownership, but there's a whole host of other data sets, loan characteristics that really should be recorded on that asset. So including stuff like the verification activity, the service and payment activity, and so on. So what we've been building is the protocols for how that loan information should be recorded in such a way that the industry can realize the maximum value around there, but recognizing that it is a multi-phase approach. This is going to take a number of years to get there, and I think we'll go through a hybrid period of what might be called asset-backed tokens or loan-backed tokens, where the loan remains off-chain and there is a token created associated with that loan. But that's down the road. There's a number of steps before we get there. So the first step, our phase one product, has been around the collateral pledge activity and recording a mutable record, ensuring that there is solely one record of a loan being pledged to a credit facility. And why we started there was very much around establishing a minimum viable ecosystem. As you're probably familiar, the ABS world is pretty concentrated. There's 10 or 11 banks that are underwriting and providing the warehouse facilities for 3/4 of the market. So establishing that minimum viable ecosystem is relatively straightforward. So, we've been working with those guys and partnered with IBM from a technology point of view in building the platform for recording all of these loan characteristics, culminating with the full asset being on the blockchain, but starting with this relatively straightforward data set around the loans that have been pledged as collateral to the investment banks as senior lenders.
Right. Okay. So I want to talk about securitization, but before, I don't remember exactly when we met, but it's been several years ago now. You've been around the marketplace lending space for a while. What was it about this market that was, because obviously a loan product, what you're selling could apply to any loan.
Right.
Loan. What was it about marketplace lending that attracted you to really focus there?
Sure. So, we started there and have in recent months sort of extended into other asset classes like student auto cards, etc. But we started there and we continue to sort of put a lot of our resource there for a couple of reasons. Firstly, there's a lot of innovators in that world. There's some pioneers who are pushing the boundaries. So, we fully expect the innovation around blockchain to come out of that world. They're more open to new ideas and easier to work with. And guys like Ron Suber and Mike Cagney are pushing the envelope in terms of how things should be done. Secondly, in terms of creating that minimum viable ecosystem, it is a nicely concentrated, relatively small asset class relative to sort of credit cards and autos, etc. So really there are half a dozen marketplace lenders driving most of the volume and supported by half a dozen investment banks providing a lot of the initial capital and underwriting activity. So it's a pretty well-contained, tight ecosystem that works together pretty nicely.
Right. Okay. And so then you said you've expanded beyond that now, and you started talking with some of the banks. Now, I imagine it's a challenging thing to do, to talk to these banks, because you're asking them to really change the way they're doing things. Obviously, they can recognize the benefit, but there's also the pain involved of changing the way they do it. So, I imagine it's going to be a very long lead time. But just tell us a little bit about how those conversations are going so far.
Sure. So we've been working with the majority of those big banks for some time now. So off the back of the earlier sort of research and planning I was talking about, 2017, we ran multiple working groups with the big banks in terms of helping to understand those pain points and efficiency opportunities, and really prioritize the roadmap, and starting to introduce them to some of the concepts associated with the blockchain as to how they might be able to help. I think over the last 18 months, they've come a long way in terms of, whilst ABS hasn't to date embraced blockchain, but in recent months, I think, we've seen the needle move quite considerably. So in the autumn, most of the big banks brought along their blockchain strategy people to ABS East, which was, very, very encouraging. So, whilst it wasn't their first use cases, sort of POCs within the banks, the majority of them now are actively engaged in terms of how can we take advantage of this technology to improve some of the inefficiencies of the ABS and MBS markets.
Right. So then, when you look at securitization, and I was at ABS East as well, and I was struck by how little has changed in securitization, given the disruption that's happened in all other, so many other areas of the broader financial ecosystem. The ABS markets still seem to be doing things pretty much the same way they were doing them a decade ago or even 2 decades ago, with slightly better technology. So, do you think you said that they're getting proof of concepts going, and they're doing, some of the banks are embracing this, but I just wonder if, securitization is, it's a massive industry, multi-trillion dollars industry as far as total volume goes. Is the problem big enough for them to really completely transform the way they do things, say over the next 5 years? Tell us, maybe you could basically say what's fundamentally wrong with securitization today, and how big is the pain point, and then what you see as sort of the, where this is going to go in 5 years' time. A lot of questions there, I know. So take your time.
Sure, no, all good, and I'm glad you sort of framed it in the sort of 5-year window, because of this is a multi-year journey. But winding back to what are the challenges, you're right that the industry structure and the underlying process and how transactions occur hasn't changed for decades. It's slow. Transactions are measured in weeks, sometimes months. It's expensive. There's multiple service providers generally doing a lot of the activities pretty manually, very siloed. So there's no shared infrastructure, no shared system of record, which in virtually every other asset class there is some system of record, shared infrastructure, keeping track of things, and paper documents representing the underlying asset in still the majority of use cases. So that model and all of those inefficiencies, which culminate in significant fees, which everybody has to bear some of those fees. That represents the opportunity. Why the banks didn't choose that as its first use case, I think that they obviously started with a lot of trading and settlement use cases where there was low-hanging fruit, or certainly appeared to be low-hanging fruit in terms of trapped liquidity, of improvements there from the blockchain, but also because I think there were existing intermediaries that could help facilitate that. So in a lot of those instances, there was a TTCC or a stock exchange, or there was a party that could help facilitate that. I actually think that many of those early POCs struggled because of some of the performance and scalability issues of the blockchain, whereas ABS, despite the sort of data challenges that we have, is actually relatively low volume in terms of the volume of data and in terms of the volume of transactions. So in that regard, the technology is fairly well suited to the ABS and MBS market. Where there lies a challenge is more the social constructs and more how we as an industry organize ourselves in terms of the adoption of that technology. So, that's a lot of what we're doing is around getting the right incentive structure and network effects and getting the right standards in place for the industry to be able to embrace this technology.
Mm-hmm, mm-hmm. Okay, that makes sense. So then can you give us some sense of the traction that you're getting today? Like, I don't know if you can share names or of lending platforms or banks you're working with, or just give us some sense of how you're going.
Sure. So in the context of immutable recording the collateral positions, we've got close to 1 million accounts, largely collateral associated with the digital lending market. So across the main 7 or 8 digital lenders, all of the guys that you would expect. And to my earlier point, in the autumn we extended coverage of collateral that we can record beyond the digital lending space into auto, cards, equipment, small business, student, really to support the entire ABS desk.
Mm-hmm. Mm-hmm. Okay, so what's it going to take? I mean, I think this is not going to be a quick process, but I also could see a time. Like maybe it's 5 years, maybe it's 10 years, that we'll look back and think, how the heck did we ever do it the old way? Why? The thing that struck me, we are here in almost 2019 and we're talking about hundreds of millions, billions and billions of dollars in transactions where documents are based on paper. And that to me, I mean, and you're not talking about something that you're talking about words. This is not like create some really complex, structural, architectural type stuff that really is hard to put into paper. You create a PDF, of a lot of this stuff. It's not rocket science. So it's staggering to me that I went through the mortgage process 2 or 3 years ago with a financial institution that. Totally paper-based, like 100%. They wanted me to fax things in, and I said, "I'm sorry, I don't have a fax machine. I'm not going to get one." I ended up, anyway, that's a whole nother story. But my point is, it's amazing how broken it is, or how backward, not broken, how backward it is. So maybe you could take us through, give us a picture of where you think it's going to be, whether it's 5 years' time or 10 years' time, and maybe you could sort of just what efficiencies are we going to gain?
Sure. So I think the end state is all of these loans being represented natively on the blockchain, such that is the sole representation of the loan. There is no paper copy, there is no PDF. It is solely on chain with all of the other loan characteristics, the verification, all the servicing payment data, and various other characteristics that give that asset the sort of the certainty. And the party in possession of that loan effectively has the ownership, and it's as easy to transact as a cryptocurrency as a Bitcoin. And there are digital asset groups at banks and other places talking about credit as a digital asset class that can be traded electronically in similar fashions to equity and FX. I think that the challenge there is less of a technical one and more of a regulatory one in terms of does the loan then become a security and require all of the cost and reporting associated with being a security, which at the individual loan level, obviously would be challenging to bear that cost. But I would anticipate that when a loan is on the chain like that it would be the ability to actually dice and slice and fractionalize and come up with new financial products in the structured credit space accordingly, and leveraging smart contracts in terms of managing the payments associated with those. I think the way that loans are pooled has the potential to change dramatically. But most importantly is the cost of actually funding and pulling together these transactions should lower dramatically, and the actual time involved in doing so should be much faster. I expect they still will generally be pulled up, and those additional layers of trust provided through the rating agencies and other parties to the larger institutional investors. But I think that the way in which those transactions occur becomes vastly more efficient, and there's significant savings, across that whole value chain.
Right. And so then you're also looking, I mean, we all saw The Big Short or read the book or both, but, where you've got Michael Burry there sitting at his computer looking at what's actually inside some of these pools of loans and seeing that they're going to be in trouble. It seems like to me when obviously you got the cost benefit, you got the transparency benefit as well, where, you look at the financial crisis, which, had a lot to do with these mortgage-backed securities that were, way too, there's many reasons which I'm not going to get into here, but the point is the securitization pools, these pools of loans, when you've got them on chain, I presume, and this is going to be completely transparent to anybody, right? There's not going to be this kind of hidden layer that was prevalent, has been prevalent really till now.
So blockchain clearly has the potential to improve transparency, but I would prefix that with the appropriate access controls. I think what it applied appropriately would have helped considerably in the context of the financial crisis. As a underpinning technology and sort of infrastructure, it would have enabled much easier reporting and transparency if the parties involved wanted to provide that
right.
transparency downstream, and could help ensure that certain information wasn't misrepresented, or if it was changed, that there was the immutable audit trail of any changes, and the challenges around the borrower verification, income verification, misrepresenting of income, that none of those would have been feasible. So it definitely would have has the potential as a technology to have removed a lot of the risk in terms of sort of transparency. You're still dependent on sort of the relevant parties giving access to the other parties of that data, but it would certainly have become a lot easier for them to do so. And I think a lot of the 2008 issues weren't necessarily that people didn't want to give access to that data. It was just very hard to actually get all of the relevant loan data in front of the relevant investors. So I think as an underlying technology, it should help to do that quite dramatically.
Right. Okay, we're running out of time, but a couple of things I want to get to. I published a piece recently on what Mike Cagney's doing with Figure and Provenance. How what you're doing at GDR, how is it different and how is it similar to what sort of the Provenance blockchain is trying to do?
Sure. So Mike and the team are doing some great work over there, and I think they share a lot of the same vision for provenance longer term, and they see some similar inefficiencies in terms of how credit is financed. And we both chose to work with IBM Hyperledger using some similar underlying technology. I think how we're tackling the opportunity is somewhat different how they're tackling the opportunity. So we're focused on working with a group of banks as our minimum viable ecosystem and going deep on a specific use case as part of that asset characterization, i.e. the collateral pledge activity as our phase one, whereas Provenance is going end to end in terms of the digital asset creation, partnering up with their colleagues at Figure in terms of demonstrating that minimum viable ecosystem. So they're sort of tackling the opportunity in a somewhat different sort of go to market way. Mm-hmm. We see this as a very much a phased approach, multi-year, to getting to that sort of end state of the truly digital loans, and a lot of that around creating standards and common ways to be recording loan information on chain, getting the incentives model right, and the sort of social constructs are absolutely critical. And I think we're taking a position that there still will be a requirement for many of those third-party services that you see exhibiting around ABS East and elsewhere in terms of custody and trust services and legal and verification, etc. But they will evolve dramatically and can and will be a lot more efficient in this end state. But I think in general, the parties that we're working with, they still want an independent third party to stand behind all of those activities, but
Right.
do them in a much more automated, efficient way. They don't want to hold keys to a set of digital loans and custody themselves, and nor do they particularly want a startup doing that. They want a trusted custody provider, but it's probably more like a Fidelity cryptocurrency custody service than it is your traditional warehouse of paper loan documents. So we're working with incumbents to bring them on that journey. Some of whom I'm sure will embrace the technology and the journey. Others not necessarily, because it's hard, because it's for the incumbents, it's not just a new technology, it's a new business model, and in many instances it's probably a lower price point automated service, but should be a more profitable service for them.
Right. Okay. Then. So last question then. So when you look, we're recording this in at the very last day of November. As you look to 2019, what are some of the goals that you want to achieve in 2019?
So my principal goal is demonstrating this minimum viable ecosystem working. So we've already shown the technology works. We've already got a number of banks using it up and running in production with IBM. We want to demonstrate real value across a significant group of banks, which, as I say, the ABS market is principally 10, 11 banks. So we want to get a significant proportion of those, actively using it across multiple asset classes at scale. And for us, that is the minimum viable ecosystem for phase one that then gives us the platform to do other interesting stuff, phase 2, 3, 4 in the coming years.
Okay. Well, best of luck with that, Charlie. It's been a pleasure chatting with you today. Thanks for coming on the show.
As always, thanks, Peter. Cheers.
Okay, see ya.
Bye.
You and I look at the securitization market, and I look at and see processes that are unchanged for decades, and extra costs and time in the system. It's just inevitable that this is going to change. Market forces are going to catch up and demand a cheaper and quicker way of doing things. So I think, whether it's Global Debt Registry or Provenance or another system, I feel like it's inevitable that we are going to have a blockchain-based securitization market. It may take 5 years, it may take 10 years, but eventually securitization will be unrecognizable from the way it is done today. And, I certainly think that will be a good thing for most of the players involved. It certainly is going to be a more efficient system. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's show was sponsored by Lendit Fintech USA 2019, the world's leading event in financial services innovation. It's coming up on April 8th through 9th, 2019 at Moscone West in San Francisco. Registration is now open, and we're also taking speaker applications. You can find out more by going to lendit.com/USA.